Good day, grade 12 ABM learners. I am Miss Precious Gregorio and welcome to another exciting business finance episode here in DepEd TV. Before we begin, let's take a look at the objectives of this lesson. The learners should be able to describe the primary activities of the financial manager, explain how the financial system works, and distinguish a financial institution from the financial instrument and financial market. As part of the introduction to financial management, we will learn about the concept of a financial system. I'll share first with you a story. Once there was a boy from the city of Manila whose name is Jose. He used to help his parents do buy and sell at a small store in the market. Unfortunately, their business had wiped out because of war. He also lost his parents. From that day, he started to stand by himself and looked for ways to survive. He sold boots from the dead soldiers that were still useful. After saving a certain amount of money from selling boots, he started to build his own business, then expanded his business and became a successful businessman. How did he do that? Jose, as the store owner, made a corporate organization. Remember from the previous lesson that there are members of an organization that will play a role in the decision-making of the company. And one of the members of that organization that plays a significant role is the financial manager. The financial manager, which is the same as the vice president for finance, also as well as the chief financial officer, makes financing decisions that require funding from investors in the financial market. Meet Pedro, the financial manager. How did he come up with his financing decisions? There are four primary activities or functions of a financial manager. First is financing decisions. The next one is investing. The third one is operating decisions. And lastly is declaring dividend policies. In financing decisions, it includes making decisions on how to fund long-term investments such as company expansions and working capitals to determine the appropriate capital structure of the company. Capital structure refers to how much of your total assets are financed by debt and equity. If it was bought using cash from our pockets, it is financed by equity. On the other hand, if we used money from our borrowings, the asset purchase is financed by debt. In this figure, the total asset is financed by 60% debt and 40% equity. Accordingly, the capital structure is 60% debt and 40% equity. Do you think there is an ideal mix of debt and equity across corporations? The answer is no. The mix of debt and equity varies in different corporations depending on the management strategies. It is the responsibility of the financial manager to determine which type of financing, debt, or equity is best for the company. The second function of the financial manager is investing. The financial manager should use tools like budgeting, forecasting, and capital budgeting analysis to determine if the investment should be in the short term or long term. Short-term investment decisions are needed when the company is in an excess cash position, whereas long-term investment visions profitability in the long run, especially if this investment would be financed by debt, so that the lenders should also have the confidence of lending the company any money. The third function of a financial manager is operating decisions that deal with the daily operations of the company. The financial manager should determine how to finance working capital accounts by short-term or long-term sources. Short-term sources are those that will be payable in at most 12 months, like short-term loans with banks or suppliers' credits. Long-term sources, on the other hand, matures in longer periods. As you can see in our figure, the interest rate is generally lower in short-term loans as compared to that of long-term loans. Hence, short-term loans lead to a lower financing cost because this source matures in a short period. But there is a possibility that the company may not be able to obtain enough cash to pay its obligation. While in long-term sources, though there is a higher interest rate, it gives the company more time to accumulate cash to pay off the obligation in the future since it has a longer time to mature. And the last function is dividend policies. These determine when the company should declare cash dividends. Remember that corporations pay cash dividends to existing shareholders or investors based on their shareholdings in the company as a return on their investment. And non-declaration of these cash dividends may disappoint these investors. And before a company may be able to declare cash dividends, two conditions must exist. First, the company should have enough retained earnings or accumulated profits to support cash dividend declaration. And second, the company must have cash.
Again, the four functions of a financial manager are financing decisions, investing, operating decisions, and making dividend policies. Let's have a check review. What is the primary goal of the financial manager? A. Minimizing risk. B. Maximizing profit. C. Maximizing wealth. Or D. Minimizing return. If your answer is C, then you're right. The primary goal of the financial manager is maximizing wealth.
Now, do you think Pedro, the financial manager, had maximized the wealth of their company?
Before we answer that question, let me introduce to you Maria, Jose's friend, who is also into business. During her management of money, some cash would remain. What do you think she would do with the cash? There were just two. A. Save or invest. B. Spend. Yes, Maria usually saved money in banks or invest some in stocks, mutual funds, and insurance. Was she A. Saver or B. User? Yes, she is a saver and capable of being a supplier of funds.
Did you know that Jose expanded his business but his company way back then had not enough cash? How is that possible? Pedro, the financial manager, was responsible for getting additional funding. But where or to whom he got the additional fund? Yes, you're right. Pedro went to ask Maria. Thus, Pedro is a user or a demander of funds.
Pedro knew that Maria had excess money and he approached Maria to lend him the capital he needs to expand Jose's company for a 20% interest. Since Maria observed that the company has been profitable, Maria was willing to lend Pedro the money since she was confident that the company could repay the loan. Maria was now expecting to be 20% richer from her lending to Pedro, and Jose's company can now expand its operations to gain more profit. Then they might agree to make a private placement. A private placement is the sale of new security directly to an investor or group of investors. The sale of new securities can also be made to the general public, and it is referred to as a public offering. And the first offering of stock is called an initial public offering or IPO. But with their case, it is a private placement, and it will only happen if Maria knows that Pedro is in need of funds, or if Pedro knows that Maria is willing to invest the funds. But what if these facts are unknown to them?
Then, they can now go both to a financial market, an organized forum where the supplier funds like Maria and users of funds like Pedro meet and make transactions. Once the saver and the user have met in the financial market, they can now agree to make a private placement. If the saver and the user do not want to make an effort to find their counterparty in the financial markets, they may go both to a financial institution that will receive Maria's supply of funds and match it with Pedro's demand of funds. Unlike in the financial markets where Maria and Pedro know to whom the funds went and from whom the funds came, financial institution serves as an intermediary to the supplier and user of funds. Moreover, financial institutions actively participate in the financial market as both supplier and user of funds. Some examples of financial institutions are commercial banks, insurance companies, mutual funds, and pension funds. Due to the increased need for security for the obligations arising from the transactions, and due to the growing size of the financial system, the transfers of funds from one party to another are made through financial instruments. These are the obligations to transfer cash or other assets in the future. When a financial instrument is issued, it gives rise to a financial asset on the one hand and a financial liability or equity instrument on the other. Yes, you're right. Suppliers of funds hold the financial assets while the users of funds make the financial liabilities and equity instruments. So, when companies need funding, they either sell debt securities or bonds or issue equity instruments. The proceeds from the sale of debt securities and issuance of bonds will be used to finance the company's plans. On the other hand, the investors buy the debt securities of equity instruments in hopes of receiving returns through interest, dividend income, or appreciation in the financial assets price. And that's how the financial system works. Do you think Pedro did a great job? Of course, yes. Pedro made it possible to expand Jose's business and their company. How about growing your future business? Remember that financial managers make financing decisions that require funding from investors, like Maria, who provide the funds that are to be used by financial managers to finance corporate growth, or from other investors in the financial market that purchase securities to invest their funds.
Now let's see what you've got. Question number 1. True or false? To achieve the goal of profit maximization for each alternative being considered, the financial manager would select the one that is expected to result in the highest monetary return. The answer is true. Question number 2. True or false? Financial markets are intermediaries that channel the savings of individuals, businesses, and government into loans or investments. The answer is false. It should be the financial institution that serves as an intermediary to suppliers and users of the fund. Question number 3. A life insurance company is one financial intermediary handling individual savings. It receives premium payments that are placed in loans or investments to accumulate funds to cover future benefits. It is an example of A. Financial market, B. Financial institution, or C. Financial instrument. And the answer is B. A life insurance company is an example of a financial institution.
How was it? I know you did a great job. Congratulations! And that wraps up our episode. Thank you, everyone. Remember that make wise decisions now so you won't cry tomorrow. Once again, I'm your business finance teacher for today, Miss Precious.